Okay, we're back with Charlie Burton, as founder of Easy Trader, and the co-host today, Mike Ingram, strategist for BGC Partners. We've got a lot to get through, Charlie.
We have, yes.
So let's get through it, and no interruptions from anybody.
Well, I think we've got about 60 seconds per bullet point.
That's right, yes.
Crazy,
so let's go ahead with the bullet points. This is exciting.
Okay. You've got the bullet points, haven't you?
I thought they were on the screen.
I thought they were on the screen.
Right, well, obviously not. All right,
okay.
Tip number 1, trading mechanically is questionable.
Right, okay, these are my top 10 tips, basically, for how to make money from trading. So my top 10, your top 10 might be slightly different. So the first one is trading mechanically. I do have a bit of an issue for a lot of retail traders trading mechanically. So trading something which is a specific pattern, let's say, where they have to take every signal in a pattern, because as you know, that as soon as a mechanical type of system like that or strategy falls over and has a drawdown period, the trader starts to then second guess, oh, should I stop trading it as soon as we're in a drawdown period, or is that drawdown period actually going to be something a lot more prolonged and they should actually stop it entirely? It's very, very difficult for a trader to follow a mechanical system. For that reason, I think that that's my top 10 tip number 1. I think for most traders, trading mechanically is very difficult.
Okay, all right. Number 2, use multiple timeframes plus setups.
Yeah, the multiple time frame analysis, I think all traders should embrace that. Top-down approach. Whatever your time frame you're trading, whether you're a day trader or whether you're a swing trader, you should be using a top-down approach. Look at the higher time frames first and then condense it down to the lower time frames. You'll get a much better read on the market rather than trying to have this blinkered singular time frame approach, which lots of traders do have out there. So they should incorporate that. Then you can put a strategy around that, read the markets first of all, then employ the right strategy at the right time.
Okay, so the hourly chart says buy and the 5-minute chart says buy, and then you buy.
Yeah, basically, yeah.
All right, vary position size.
Yeah, I know this one's, a lot of people are not going to like this one because this is something I do, which is to vary my position size. But a lot of people have this approach, well, you should risk 0.5% per trade of your capital. Whereas for me personally, if I look at a trading setups, you can't always have exactly the same sort of setup which you feel that you have the same confidence on. So some setups I still want to trade because they might have a fantastic risk to reward, but I know that the win rate on that strategy is probably not quite so good, but it's worthwhile trading. So I'll actually downsize my position size on it, but if it pays out, then it'll still have a great risk reward on it. So I vary my position size, and I would encourage people to do that.
Actually, this is the best of the 10, in fact. I think that's the best idea of the 10, because you want to be in the market, but you think it's really risky, selling a spike or buying a dip, etc. Yeah. And in fact, you find that if you've got a toe in the water, you read with that, which doesn't cause you stress, you can read that position and read that market much better. Even if it's just 10 pence a penny or whatever it is. So that's I think.
Yeah, but you're not connected to it. If you're not in the trade, then you have no emotional connection to what's going on in that market anyway. And if you're in at full position size, you're too emotional.
You're sweating away, yes. And, and all the other things people normally have, from what I see, people have position sizes which are 2, 3, 4 times bigger than they should have for that account size and for whatever they're comfortable with.
Yeah,
and
exactly.
Being over leveraged is actually the number 1 cause of a downfall. Anyway.
Yeah. Well, no, you should have, I say that you should have a level, so let's say it's 0.5% of account that you're going to risk as a maximum, and then within that 0.5% you vary at that position size, like you say. So your 0.5% is your maximum, and then you can play around within that, yeah.
Okay, and nobody, I mean, that's the other thing, no spread better, it risks 0.5% of their account. It's like 20 or 30%
this is the
at
thing.
Any one time.
Well, spread better can't, because a spread better's got £1,000 in a trading account, they just don't have enough capital to, if they're trading at 0.5%, there's no emotional connection to the trade anyway. But I agree, yeah, I've just pulled that out.
Number 4 on the hit list, risk management and risk reward is paramount.
Yeah, it's such a cliche, isn't it? But if you don't risk that, if you decide to go and risk 5% on all your trades, you're putting yourself at the mercy of the markets, and very quickly you're going to go and have a 20, 30, 50% drawdown. So very, very difficult. And risk reward, yeah, run your winners more than you run your losers. It's simple, but it has to be in the top 10.
But how do you do that? You've got a position, it's like 100, 200 quid, 300 quid ahead. Your stop losses at break even. Is it easy to run a position like that?
If you're willing to lose, let's say £1,000 on a trade, you have to be willing to make at least £1,000 on the trade on the profitable side. If you're willing to lose £1,000 based on your price per point, and where your stop level is, that means you would lose 1,000. But then you come out as soon as you've made 200, you're in all sorts of trouble. So that's what I'm saying. You must run your winners. They don't have to be a 5-to-1 risk reward every time, because you're not going to get that. But you have to be looking at a positive outcome as far as risk reward is concerned.
I think running winners is the most difficult thing to do.
It totally is.
Almost,
I use targets. I know you don't. You just trail your stops.
I would actually just walk out of the building and leave the mobile phone and just go away.
Right.
And let that's the only way that most people can.
Actually, I've done that today. You'd be proud of me. I did it on the train this morning. So I don't trade the FTSE.
Right. Okay, I'm just trying to. All right. Okay. Mindset is everything. That really is related to that point about being able to run profits. You need to be cool.
Mindset is everything. It doesn't matter. You could have the best strategy in the world, giving you a 95% success rate. It's not going to prepare you if you haven't got that thick skin. You have to have a skin like a rhino. Otherwise, you're not going to be able to deal with the knockbacks. Because you and I both know the market's there to give you knockbacks time and time again. If you haven't got that thick skin, you haven't got that mindset, you won't crack it as a trader.
Right. Ignore the noise.
Yeah, I put that one in there. Yeah, considering where I am. But yeah, for example, one of the brokers I trade through, their chief market analyst is useless. If every market call that he ever puts through, you might as well go and do the opposite.
Don't look at me.
It's noise. There's a lot of noise out there. I know.
How do you know he's useless?
I've seen his calls.
Okay.
And so yeah, I think a lot of traders get sucked into following analysts and the likes, and they've got to try to make their own trading decisions. And it's very difficult because sometimes a trader may have their own trading decisions, and then they'll look out there in the market for people that have the same fundamental decision, and so that they then can concur with their own decision. But you have to look at all aspects of the market, or just shut it all off, turn Bloomberg off, and just focus on your own trading.
I would just look at Credit Suisse's analysis.
Keep revisiting that.
I think they're very good. It's an in joke there. Right, ignore those making wild claims.
Yeah, I know. And coming from me, who turned 10,000 into 200,000, but that was a fully automated, audited accounts. There's a lot of people out there who make all sorts of wild, unsubstantiated claims using demo accounts, hidden as real accounts, and there's all sorts of ways that these people out there can do it. There's lots of people making wild claims. If they're quite wild claims, they probably aren't true, and you're better off just plodding along.
If they're very expensive, is that sort of under the wild claims type of?
If they're very
stable?
expensive, yeah, probably as well. Yeah, if you've got a lot, I hear there's some trading educators who are charging upwards of £30,000 for trading courses. So
I'm cheap, zero.
Me too. Oh, you're zero.
I charge zero at the moment.
Right,
because that's how good I am.
Yeah.
There we are. Right, there's no single correct way to trade.
Yeah, there's not. I have my personal styles. You have yours, like everybody does, and there's no single way to correctly trade, but there's certain things that you do need to do. Risk management, like we've already said, you need to find a style that's right for you, whether it's depending on the time frame. You could be a day trader, you could be a swing trader, you could be a position trader. You've got to find the right style for you, and that is the right way to trade. There's no one way that you or I can tell everybody out there that you must do it our way, because that's not true.
It takes longer than you think.
Yeah, it does. You and I have disagreed about this in the past, but I think for short-term traders,
I don't think we've disagreed on anything.
I think we do. We have. Yeah, I'm sure.
Your jacket, I would disagree on, but that's about it.
Coming from you and your little cardi.
Well, Dunican.
It does take. Most people think when they get into trading, they think they can go on a course for a weekend or so, and then that's it, and they're going to be instant success. It takes a lot longer than you think. Be prepared to lower your expectations. Make your time horizons longer, and you'll be better prepared for it.
Isn't it also the case that the markets do actually change? So the markets in the 90s are not the same as the markets now, for instance, or 10 years ago, or even before, I suppose, before the financial crisis. Totally different, really.
Yeah.
The rules
totally
of the game have changed.
Dynamic.
Yeah, they have. And that comes back to trading mechanically and all those sorts of things. You've got people who put blinkers on who think, I've got to have this wonderful signal that's coming up on my charts, I'm going to follow that forever. Yeah. It's not going to work forever. The market cycles change, the dynamics. I've changed greatly over the years. I still use certain aspects of my trading, which I've always used, but you still have to adapt and change. And I think that comes on to the last bullet point, actually.
Be willing to adapt.
Yeah. It's like the old Bruce Lee analogy in one of his movies when he said, you've got to have a mind like water. You've got to be able to adapt. And we've got the Rugby World Cup on at the moment. And there's always that analogy that...
I thought that was over.
He's for England. And But
Sorry.
they always talk about heads-up rugby, and you've
Yeah.
got to be able to adapt to what's going on in front of you. And when it comes into the markets, yeah, you can have a strategy or whatever. You've got to be able to recognise when the market cycle's changed enough that you need to be able to adapt to it. And if you don't adapt, you will not survive in the markets.
Charlie Burton, founder of Easy Trader. Wonderful stuff. We managed to get there.
Did we?
I don't actually know how many minutes it's taken, but
Right.
it doesn't really matter. We've got through it. We got there, and hopefully we'll come again soon on the
I'll
program.
probably be back on that side again.
Hopefully, yes. You do much better than I do.
We'll see you soon.
We'll be back after the break.